Today, folks, I have comprised a list of dividend stocks that, dare I say, are outperforming the market and are actually green year to date. And I wish I could find companies outside of dividend stocks, but I have been stock screening, going up and down the internet, and I haven't found really any. So if you have any stocks that are actually up year to date, I want to hear about it in that comment section. And before we dive down into that list, I want to expand our minds globally to think about the global picture, get outside of our US and Canadian bubble that we live in here, and talk about the Shanghai composite, the Russian composite, and kind of compare it to the current S&P 500. And if this is a conversation that interests you, as always, just do the channel a favor, hit that like button, folks, because first and foremost, let's just talk about the US markets, the bread and butter of what every mutual fund and hedge fund manager compares themselves to, and dare I say myself, every investor does, and that is the S&P 500 index, which currently where we stand today is trading down just about 11.91%. It still hasn't found a bottom, and it looks like we could potentially be heading into bear territory, but only time will truly tell. But when I keep reminding my mother that, oh my God, the markets are falling apart every day, this is insane, I'm happy to have a bit of cash here, and she's like, what are you talking about? The markets are doing just fine. And that's because my mom lives in the bubble of the Canadian composite here, the S&P TSX, and this thing has been a safe haven for global investors and general Canadian investors because this thing's only down 2.32% today. Staggering. Oh my goodness, guys. What about the Shanghai composite? Well, after all the rhetoric in China, and remember how hard China was getting battered thanks to Trump, and that continued story has finally dried up because Russia has taken the spotlight. In year to date, guys, this thing's only down 3.94%. It looks like it hit a bottom in February and is rebounding. Now, I know if you're buying things like BAB or those individual Chinese stocks, you're not feeling that rebound probably as aggressively as the index might be right now, but still impressive, still outperforming the S&P 500, but has gone through an insane amount of volatility over the last year because of that rhetoric. Now, Russia taking that spotlight, guys, has been feeling pain. They are hitting 4-year lows right now. Year to date, it is down 25.87%. This is full-blown bear market territory for the Russian economy, and considering they're locking up pipelines, adding sanctions to banks, I can't see how Russia is going to bode well this year, and I feel bad for Russian investors, and I hope to God they're able to invest their money abroad. Now, expanding beyond that, let's talk about this list of dividend stocks because they are the only stocks that I could proponently find that are actually up year to date. And first and foremost, all of these are primarily coming out of the Canadian economy. No surprise. But first and foremost, TELUS. This is what I've been loading up on since the beginning of the year, guys, and it is currently having a 4.14% dividend yield and is up 6.25% still year to date, which is pretty phenomenal. Now, that doesn't mean it's going to continue going up. It is pretty valued here with a 25 PE, but my God, what a really nice place to hide next to the Canadian banks. Now, the banks, a lot of people think are expensive here, and I would beg to differ that I think they're valued. They're not cheap, but I wouldn't say that they're crazy expensive considering the PEs are in the low teens right now. And considering Canadian Imperial Bank has a starting yield of 4% here, it is up 7.3% year to date. Next to Toronto Dominion Bank, up 5% with a 3.4 starting dividend yield. And Bank of Nova Scotia, which is flat, just slightly seeing some green, but with a little bit higher of a starting yield at 4.39%. Now, the thing with these banks here, guys, is I'd have a hard time like loading them to the boat here, but I wouldn't say they're crazy overvalued. But if we compare it to the US market, JP Morgan only trades for a PE of 9.68 with a 2.69% starting yield, but is down 8.05%. Now, I'd still like to perhaps, if I was in the US, be buying things like JP Morgan because they're good value plays, they're good hedges in an interest raising environment, and the banks are just a really leveled place to hide money, which is literally what I have been doing to protect myself here, guys. So let's talk about REITs because RioCan is no exception to being some large cap crazy Canadian REIT. I mean, Canadian Apartment Properties is the largest one, and this one bodes somewhere down in like the top maybe 10 at the lower end. And it's crazy to think out of all those kind of large cap Canadian REITs, this one has been busting out. It has been performing exceptionally well here, up 8.82%, and has been the largest position in my portfolio. And I still think right now currently is, even though I've been scaling it down and repivoting some of that capital. But take a look at this 4% starting yield, 13 PE, and over the last year, this thing has been drastically outperforming the market. Now, I've been selling RioCan to buy Smart Centers, a very comparable counterpart. But taking a look at Smart Centers, guys, it's kind of similar. It's up 18% over the last year. Year to date, it has been flat. I mean, it is seeing a little glimpse of green if we can go up just 0.01%. But with a 5.8% dividend yield and a 6 PE. These are kind of companies where I would just park cash for the midterm. It's kind of like holding those option ETFs where people are just like, I don't know what to do with my money. I don't think you're going to do terribly wrong here in the short term if you're just looking for cash flow and just to wait this market out, which, like I said, has been my large game plan for the time being. Now, comparing it to some other Canadian REITs, I was kind of shocked to see that even Northwest Properties hasn't been doing much here. It's been relatively flat, but with a really high yield of 5.88%, guys, $3 billion market cap. This one, unlike RioCan and Smart Centers, which are kind of exposed to retail properties, some residential in there, but this guy is purely hospital based, a very comparable to something like a Medical Properties Trust, a US kind of hospital REIT that I currently own as well. And I've been debating on adding this to my portfolio. Problem is, over the last year, we're only up 7.34%. This one shows an insane amount of volatility over its history. It's up, down, up, down, up, down. But honestly, guys, if you're looking for that cash flow, this could be a really good diversifier, and it is so comparable to MPW. So I found this one to be intriguing. Again, not in the green year to date, but if you're flat on the year collecting this kind of yield, you're not really complaining, in my opinion. Now, in the energy sector, and this is the primary sector that has been outperforming, which we could talk about here, obviously things like Enbridge. Now, Enbridge is paying a 6.5% yield still somehow, and it is up 6.8% year to date. On the 1 year, it's performing very similarly to things like RioCan and Smart Centers. It's up 18%, and it looks like it's really boated out of its bottoms. And a lot of people keep saying, well, this isn't just an oil stock, Kyle, and I know it's not. It's very well diversified. It has a hard time building revenues up, which I could say the same about RioCan, Smart Centers. It's not like they're blowing revenue growth here, but for stability, I mean, I'm kind of blown away by the performance. And the only other place we're going to get that kind of performance in the US is kind of in those pure oil plays like Exxon. I mean, this thing is up 20.82% year to date. One of the largest oil companies on the planet, $325 billion market cap, 4.5% dividend yield here. And honestly, I think for as long as oil keeps boating to these highs, this is a good short-term parking place for cash. My big fear is what we're seeing as a cyclical turn in some of these companies. And, you know, when things go up, just like they do, eventually they will come down. So you don't want to be buying these things that aggressively just because they're running up. But again, I've had exposure to these companies for a very long time outside of things like Exxon or Enbridge. But I just find it really intriguing how hard it truly is to find stocks that are green this year. I mean, it doesn't matter what market you're looking at unless it's related to oil or somehow one of these really random outliers, saying the Canadian stocks like TELUS or RioCan. It's a ridiculous market here, guys. So I want to pass that question off to you yet again. What stocks do you know of are green that I did not mention here today? I would love to hear about it. Just intrigued. But stay cool, stay awesome, and as always, I look forward to catching you in the next one.